As you see, we are now perfectly ready to start. I welcome our panel. This is an intriguing session and a challenging title. As you will see, we have a panel of 4 speakers, perfectly able to deal with the subject at hand. But let me open with a few more general remarks before I introduce the speakers. Financial crisis in Europe over the past few years has imposed major limitations on national sovereignty and has Europeanized various aspects of financial regulation and supervision which were regarded as totally out of bounds a few years ago. And the experience of the countries that are represented in this panel have been crucial in triggering this process. Let me introduce them in the order in which crisis arose in Europe in the financial sectors. And let me start with Iceland. Iceland is one of course, Europe's smallest nation and not in the euro area, not even in the European Union. Has recently confirmed that it doesn't intend to be in the European Union. But crucially, for current purposes, she's a member of the movement towards freer capital markets and common financial rules across borders in Europe. She subscribed to that. And that includes, of course, banking activities. And the 3 largest Icelandic banks, as we know, were very large relative to the economy. And shortly before the crisis, they became too much to handle for the domestic supervisor in Iceland and for the arrangement for deposit insurance. Home country control, however, is the principle in Europe for financial regulation. And national supervisors in the countries of the Icelandic banks where they were active were not able to intervene in the first instance. I think the Icelandic experience is a key element in developing some European rather than purely national supervision in the financial sector, though it did take another 6 years to arrive at a single supervisory mechanism for countries that are in the banking union. And here our speaker from Iceland is the governor of Iceland's central bank, who came back from his responsibility at the BIS to lead the bank and was confirmed last year for a second mandate. Iceland is now back to growth, but after a painful adjustment monitored primarily by the IMF. And nobody could be better placed, of course, than Governor Gudmundsson to tell us how Iceland managed that transition. Some months after the crisis, Ireland was hit severely. After the failure of Lehman, that triggered massive financial instability, nowhere more so than in Ireland, which had for the first decade in Europe been Europe's fastest, most successful growing economy. This vulnerability in Ireland was due not to foreign excesses by Irish banks, but to domestic adventures, financing a huge build-up of activity in the construction sector, mainly of commercial property. As assets prices fell, drastic measures to save the financial sector became imperative, and the government stepped in at the end of September 2008 with a massive wide-ranging guarantee to Irish banks. And that in turn triggered similar actions by other governments in Europe. And when the costs of the Irish rescue package became known, it added no less than 30% to the Irish public deficit. The size of this national bailout was probably the most significant single inspiration for the subsequent initiatives to so-called break the vicious circle between banks and sovereigns in Europe, the heading for the proposal to move to banking union in 2012. Moving away from bailing out banks by public funds to bailing in most of the creditors of the bank. The Bank Recovery and Resolution Directive that has now been passed in the European Union in 2014 establishes these principles with bail-in provisions so extensive, 8% of total assets of the banks not weighted by risks, before public funds can be called upon. I think it's true that among all the bank resolutions that have been carried out since 2008, only the largest single one in Ireland, the Anglo-Irish Bank, would have required relief above the limits of the present rules in the BRRD ceiling, and hence injections of public money. Governor Honohan of the Central Bank of Ireland resumed his role in 2010, some months before Ireland lost access to financial markets and had to call in the Troika, the IMF, the European Commission, the European Central Bank, and he has played a crucial role ever since in turning that rough experience into what has been the most successful of the national programs to re-establish access to financial markets for European countries. No doubt the conditions in Ireland were propitious for that, more so than in other countries and programs, but few had expected Ireland so quickly to resume her place as the fastest growing euro area economy, though that is now less demanding than it was before the crisis, surely. And it'll be fascinating to listen to Governor Honohan's views on whether Europe is about to find an appropriate balance between national sovereignty and European financial stability in the area of bank recovery and resolution, the direction of which has in no small measure been shaped by the Irish experience itself. That vicious circle between banks and sovereigns can be broken, of course, by bolstering the capital of the banks and by rescuing them. But it can also be broken by limiting the extent to which banks have responsibility for absorbing government bonds. And many sovereigns in Europe have come to rely on financing large public deficits by selling bonds to their own banks, and sometimes also, of course, to other banks. Sovereign bonds have been regarded as safe assets, providing the incentive for banks to accumulate them beyond what is prudent. There are now initiatives to limit that, but Greek banks had not overlent to the private sector or to foreign borrowers. They had to overlend, if anything, to their own government. There are now initiatives to limit the size of bond holdings, not by introducing risk weights to the bonds, that is too tricky still, but by setting a maximum share of a bank's balance sheet that can be invested in the debt of a particular government. That's one of the experiences that I see it from the Greek experience, which could in a not distant future shape the more limited degree of national sovereignty in the financial area where European countries have seen it in their interest to move in that direction. Greece is, of course, and we're very fortunate to have Janusz Varafakis with us here, a crucial case study in a number of other areas of financial crisis as well. And both Janusz Varafakis and our last speaker, Thomas Fasi, will raise broader issues of the purposes and actual uses of funds made available to program countries and to Greece in particular since 2010. Were considerations of financial stability, no contagion in other parts of Europe, given too much importance? Why did the restructuring of debt have to wait so long? Since some creditors, the IMF in particular, was in favor of doing it earlier. And is there an overemphasis altogether on the revival of the banking sector? These issues certainly need a critical review, and we shall have that from Janusz Varoufakis and from Thomas Fasi, who will also draw, I think, on his Italian experience, which has special flavors in interventions from Europe without any program or without any formal negotiations. I hope we can focus somewhat on the national experiences of these three countries. I will not follow exactly the order that I've mentioned them in. I'll start with Governor Patrick Honohan first, and then I will go to Janusz Varoufakis, and then to Mark Gudmundsson, and finally to Thomas Fasi. We do have a fair amount of time until 12 o'clock, an hour and a half, so 10, 12 minutes or so would be fine. Please. Go ahead, Patrick.
Okay, thank you. I think I'll just stand up if standing up, and anyway, there are a lot of people in the back. What I want to do is, everybody in the room knows a lot about the different country cases, including the Irish case, I'm sure. So I don't want to go through in a sort of mechanical way. I want to isolate a number of facts, sometimes disputed facts, and also I want to explode a number of myths. So presentation will be a little bit nuanced from that point of view, though how nuanced can you do in 12 or 15 minutes? So I'll start. The session is supposed to be about the European institutions' role in, and I'll come to that, but I will start with the national dimensions. So let me start with the background to the bailout, the Irish situation. And as Niels has said, pretty clear to everybody that the yes, I see now that the version of the slides is not going to be in the right order, so that doesn't matter. I wanted to start with a fact, which is that it was the unrestrained and reckless behaviour of the Irish banks that destabilised the Irish economy and the public finances. So that's a fact. That's fact one. I probably can get to it here in a minute, but yes, they're all in the wrong order. So that's fact one. There are many ways of allocating blame, but in my view, the first line of defence against what has happened must be the directors and managers of the banks. And over just a few years, this credit-fueled bubble created a pattern of over-indebtedness and mispricing that made Ireland's economic performance during the Great Recession period among the worst in Europe. With greater prudence by management and boards of banks, this bubble could not have happened. And it's also worth emphasising that international lenders too were an essential part of the process, and they were surely lucky to get their money out. That's the iconic chart that I like to show about the Irish banks and their international indebtedness running up through the boom period, and then, of course, in a somewhat disorderly way, the monies being withdrawn or repaid when due in two rapid episodes, one around the time of Lehman's and one just before the bailout. The second point here, though, has to be acknowledged, and it's a truth, but it's only partly true. There was lax supervision of the banks in Ireland, and I only say partly because, as I said, any attempt to assign responsibility must start with the banks, and I think we should keep that priority there. The supervision was not good, and I've written a long report about that, but it is the second line of defence and is not really needed if the first line of defence was working in any way well. And there are other dimensions to domestic policy that have to be borne in mind. There are the inappropriate pro-cyclical fiscal policies, including specific subsidies and tax expenditures for the construction sector. These were important factors in incentivising and supporting the credit-led boom. And those kinds of policies also hint at the political climate in which bank supervisors were operating. And of course, every loan needs a borrower, so let's not neglect the borrowers. But I do want to put that in as the first fact. The Irish situation is about banking, it's about bankers, and it's about bank supervisors and the policy climate. Now, what about, there are a number of myths. No banker has ever been convicted. Well, actually, that's not true. For the most part, the behaviour of bankers was unwise rather than criminal, so you don't convict people for unwise. Nevertheless, there have been convictions of some senior Irish bankers found to have committed a criminal offence in the latter phases of the crisis, though actually no prison sentences, so convictions without prison sentences. And there are a number of other cases, criminal and civil, still in preparation. But I would mention that the Irish legislative framework deserves to be strengthened to take account of egregious recklessness in risk-taking by those who are in charge of failed financial firms. And I sort of like the new legislation enacted in the UK of this type. It's only forward-looking, doesn't go back. Nothing can be done about the past. Now, the next myth, now I'm in disaster because I have to go back to my other myths. The next myth is that it's chiefly the bank guarantee that brought about the need for fiscal austerity and generally crippled the Irish economy. Certainly, it was the market alarm at the scale of the funds that had to be injected into the banks in 2010 and which were recorded promptly in the general government deficit, prepared in the autumn of that year, that was the wake-up call focusing global attention on the fragile fiscal situation and brought forward the need for action urgently. But redressing the emergent deficit in day-to-day spending was actually going to require a much larger, because permanent, adjustment in government revenue and spending, not least because of the degree to which boom time tax revenue fell off. Now, I want to show you, sorry for running through backwards and forth. This is a much better order than the order in the slides. Here we are. This is the picture I want to show you about the relative scale of the austerity. That's the blue line. I'm measuring austerity by the amount of policy change in tax and expenditure since the 2008 budget that has been happened in Ireland. The top left there gives you the annual, and then at the bottom, cumulated over time. So the total adjustment in the tax and spending, the total policy changes add to about 30 billion a year. Well, that's 30 billion every year, 2014, 2015, and it'll be 2016, 2017, 2018 as well. So you see, as from the bottom right-hand side, the cumulative total of austerity, measured in that way, is growing all the time, whereas the bank, the direct costs of paying the creditors of the banks, the assumption by the government of the bank debts, it spiked there in 2010. You can see the big red spike in 2010, 30 billion in that year, and there were a few amounts in adjacent years. But that's it, 64 billion minus 20-something that the government will get back, so about 40 billion. So as time goes on, and the overall intertemporal cost, the direct banking bailout. The banks caused the problem because they created the bubble, they created the mismatch between, the potential mismatch between tax and revenue and the rest of the budget. But the direct bailout of the banks is relatively small, much smaller than people think. It's just important I'm not trying to let the banks off the hook, you heard that, but it's important to bear these things in mind. Now, let me hope that I can, yes, I still have one more misordered side. The other myth is the bailout caused the recession. Okay, so some people might think that. Nobody in Ireland thinks that, but some people, history sort of blurs. Ireland went into a bailout, austerity was imposed, therefore there was a recession. No, sorry. Nice story, but it's not true for Ireland. Might be true for other countries. It's not true for Ireland. You can see the peak happens in 2007. Employment is starting to fall. Lehman's happens, and there's a dramatic fall in employment. And basically, employment has reached where the second vertical line is there at the end of 2010. That's the bailout. Employment has already more or less reached the bottom. Now, I'm saying the bailout had the fiscal contraction that continued after the bailout had no effect. No, I'm not saying that. I'm just saying the bailout wasn't the cause of the Irish recession. It's sort of obvious to anybody who knows about it, but it's worth bearing in mind. And that's employment, but you can do it, and I have them there with output and all sorts of other things. Now, let me move then, second half, to the institutions, the role of European institutions and the whole question of sovereignty. So I'll run forward to that, and I think we're probably back onto a reasonable order. Here we are, institutions and sovereignty. Well, here's the first fact here. The IMF agreed to endorse a program which risked debt unsustainability, justifying this by the need to avoid spillover effects in other countries. So that's quite interesting. The IMF went into this program. They're part of the lending institutions. They lent a third of what was lent, and they have lots of rules. And one of the rules is they're not going to lend into a country that hasn't got a sustainable debt profile. If it's not a sustainable debt profile, they restructure. But there was no restructure in the Irish case, even though the staff could not assess that there was a high probability that the debt is sustainable over the period. And I have the quotation exactly there from a published report at the time. They were upfront about this. They said, even though uncertainties around such a debt path make it difficult to state categorically that this is the case with high probability, fund support at the proposed level is justified given the high risk of international systemic spillover effects. So we're lending money to Ireland not because of a safe program for Ireland, but because it's a safe program for the world. Very interesting issue. Now, in the end, of course, the program changed quite drastically over the subsequent months. The initial interest rate, which is 5.8%, I remember the number, came down dramatically as far as the European Union parts of the loan are concerned. About two-thirds of exactly two-thirds of the lending was European Union institutions, and the interest rates on that were brought right down in the middle of 2011, about 6 months into the program, and the maturities went right out. And also at the time that the Anglo-Irish Bank that was mentioned by Niels was liquidated, the financial arrangements about that involved very long-term, low-interest rate funding for that component as far as the government was concerned. in addition, the bank recapitalisation, which was penciled in, by bailing in as many subordinated debt holders as we could manage, we managed to reduce the cost of the additional bank recapitalisation. So although at entry, and this is quite important for people looking at programs like this, at entry the program didn't look sustainable. It didn't look sustainable to the national authorities. That's not the first time I've said that. I said it at the time the government were advised. This is the best we can get. It's not good enough, but we have to go with it. But we were right to go with it because we knew since something that's not sustainable will change. And it was changed, and it was changed within 6 or 7 months. So from the middle of 2011, it became clear this now has become sustainable because the financing arrangements are different, and then with the liquidation of Anglo-Irish Bank and so forth, and compliance with the programme. But it's a very important point. Now, I have a few more myths. That's the IMF programme. That's the quotation. Senior bank creditors, EU and IMF insisted that the programme would not contain a bail-in of senior bank creditors. That's very, very well known. I put as a separate fact that the ECB again refused in March 2011 to countenance bail-in of senior bondholders. It's kind of sort of hard to understand that in retrospect. Looking back, March 2011, they're talking about a big injection of capital into the banks, and they won't tolerate a bail-in of senior bondholders of a bank that has failed completely, as one of the worst experience of any bank in Europe, probably. So it's hard to explain retrospectively, but I suppose has to be thought of in terms of the other financing arrangements around the eventual liquidation of that entity. Well, let me move to myth number 4. The EU partner countries used the crisis to leverage Irish policy changes in other areas damaging to the Irish economy. No, they didn't. They might have wanted to. It was certainly a risk for the Irish side of the negotiation that you would have a kind of unfair issue linkage. Oh, what do we want from Ireland? We want this and that. Why don't we tie this into this bailout? It didn't happen. The measures adopted, okay, the scale of the fiscal adjustment, that was certainly something that the Irish government didn't have much leeway on, but the choice of which policies to adopt was essentially an Irish decision. There's a sort of iconic example in the minimum wage. Well, actually, the Irish government, it wasn't the Troika, but the Irish government which initially proposed a reduction in the minimum wage. Troika, of course, thought it was a great idea, and that came into the programme at first. But the new government 6 months later decided, well, nobody in Ireland wants a reduction in the minimum wage. It's not relevant for employment, etc., etc., etc. And they took it away, and there was no complaint. So the policy mix, for good or ill, was an Irish choice. So the overall amount of adjustment obviously was not. Myth number 5, I'm nearly finished. It was the euro that did in for Ireland. Well, maybe it's obvious to people in the room, but it's often said, oh, if Ireland hadn't been in the euro, it wouldn't have been any kind of problem. I think that's very, very hard to defend. So I put it down as a myth. Of course, the euro contributed some fuel to the fire in the form of low interest rates, encouraging borrowing, and the removal of exchange risk on cross-border borrowing by Irish banks. But the euro was not an essential ingredient in the bubble, and several other non-euro countries also relied on the period of financial liberalisation and global savings glut to finance bubbles. Mar is going to tell us about Iceland. Latvia, same story, not in the euro area. Nothing in the euro regime prevented Irish regulatory and fiscal policy from moderating the boom. When the crash came, the decision to guarantee the banks, flawed though it was in its design, was underpinned by ECB liquidity support, which prevented the kind of chaotic currency depreciation which would surely have been the inevitable consequence had Ireland been outside the euro area. Of course, some depreciation of the domestic currency, if there had been a domestic currency, would have helped boost the country's international competitiveness. Let me give you a partly true one. This is almost my last. The European institutions pushed Ireland into the EU-IMF programme. Well, actually, I think it's sort of partly true. It doesn't necessarily mean that they shouldn't have. And the reason I say it's partly true, although previously I've pointed out that the trigger was a loss of international confidence, the spreads moving out. See, we can't live with these spreads. We've got to go into a programme. That was definitely a domestic decision. But an unequivocal public indication by Europe that it would continue to underpin the liquidity needs of the Irish banking system might well have avoided the need for a programme, but it would not have avoided the need for austerity. Anyway, such an assurance was not forthcoming in the period September to November 2010, and indeed, as now well known, ECB indicated privately in November 2010, not fully credibly, I think, to the Irish government that it could pull the plug on Irish liquidity, bank liquidity, if Ireland did not apply for a programme. But actually, already by the end of September 2010, Ireland stood to gain more from a programme than from trying to struggle along, borrowing at the very high rates available to it by that stage. And there the spreads that zipped up there the first zip up is not so impressive compared to that happened during the wider euro area crisis. But it was that gap opening up between the green Ireland and the red Germany spreads at the end of 2010 that pushed Ireland into the programme. There it is in larger detail. Ireland would have been better off with an IMF-only loan. You often hear that. I don't think so. The experience and hard-headedness of the IMF staff certainly helped keep initial and subsequent negotiations on track and may have helped avoid false steps. But if the European Union means what I think it means, it also embraces a degree and extent of collegiality that make European institutions natural partners in financial assistance for a member state that has come under pressure from distrustful markets. That's what I think it should be, and to some extent is. And for Europe to decline such a role would be a great step backwards. The member states of the European Union are bound together too closely for that. And even if there have been missteps in the handling by European institutions of the Irish crisis, as for some others, I prefer to see this as teething problems. So while the terms and conditions of the overall European financial arrangements surrounding the Irish programme at its outset can readily be criticised, they ended up in a different space and justified the persistence of Ireland staying with the programme. Well, I'm going to go to my conclusion. Obviously, I'm telling a glass half full story here. I could tell a glass half empty story, but I think it's more slightly provocative in this audience to tell a glass half full story. We may hear some half empty stories around the table. But what has struck me about the Irish bailout and others is not so much the loss of national sovereignty as the extent to which the shared sovereignty of the European Union and the Euro system was strained by the scale of the financial commitments involved and the loss of trust that was generated by the rapid emergence of these commitments. Yes, the ECB extended sums totaling well over 100% of Ireland's GDP to the Irish banking system, astonishingly large amounts, the bulk of which have, by the way, already been repaid. But having done so, it seemed to suffer a transitory lack of confidence that, despite early fiscal and regulatory action by the Irish authorities, that they would actually bring things under control. And in addition, some steps were taken, as I pointed out, for the sake of avoiding spillovers, and not specifically in the interest of Ireland. On the whole, though, it is now beyond doubt that the interest and maturity terms that were ultimately arrived at for covering the financial commitments are such as to have made the whole operation a very good net success for the Irish people and for Europe. But I also think that the experience highlights remaining gaps in the institutional structure of Europe, even after the creation of the banking union. It's less than a fiscal union. It's more than a currency union. It has survived a severe and divisive asymmetric shock, which has highlighted the importance of further institutional development. Thank you.
Thank you very much, Patrick, for this account, for your account of the Irish case. We move immediately to the next speaker, Finance Minister Janusz Varafakis, who may not have been very widely known in the world, but certainly well known to people in INET because he's been regular at INET conferences. We've had the privilege of listening to him before. The privilege today is, of course, even greater because of his many commitments. We are grateful that you are here and look forward to your comments. I understand that you will be, you have one of your colleagues from the Greek government with you, Mr. Euclid Sakalatos, who will make a few remarks supplementary to yours when you have spoken. But please keep within 12 minutes or so.
Okay. So I suspect the convention that Patrick has started has to be
Sorry.
adhered to, so I'm standing up too. Well, thank you to INET once again. It's a pleasure to be part of this impressive effort to bring old thinking back in the form of new thinking, because there is no such thing as new ideas. We have to resuscitate things that once we knew better in the past and in a more confident past. But let's now move on to the subject of today. Eurozone institutions will be the beginning, the nail on which I try to hang some ideas concerning bank bailout negotiations in the context of dealing with the euro crisis. Now, we all know that the Eurozone was designed on the basis of what I like to call the principle of perfectly separable debts and perfectly separable banking systems. We designed a monetary union on the assumption that we can run monetary policy in an indivisible monetary union along the lines of making sure that every euro of public debt is assigned to one member state, and that the responsibility for supervising and possibly resolving banks falls within the limits of national sovereignty. Now, many of us expressed severe doubts as to the wisdom of this particular architecture designed back in the 1990s. The essence of this architecture is that to work, you need to have the banking sectors separate and at the same time unified in their capacity to recycle surpluses in what is essentially, by definition, an asymmetric monetary union. So once you have a country like Greece bound together monetarily with a country like Germany, you know that you're going to have a stubborn current account surplus deficit imbalance, which means that you're necessarily going to have the banks of Germany and the banks of Greece, the Bank of Holland and the banks of Ireland, and so on and so forth, recycling the financial surpluses caused by the persistent current account surpluses from the surplus countries through the banks of the surplus countries to the banks of the deficit countries. That we always knew. It's in the nature of the beast. Now, the problem with the asymmetrical aspect of it is that there are reasons why you have perpetual deficit imbalances. So I like to point out to some who take a leaf out of the standard macroeconomic textbook, which presumes perfect competition everywhere in order to come to certain general equilibrium theorems, that however low wages in Greece fall, Greek cars are not going to gain competitiveness vis-à-vis Mercedes-Benzes and Volkswagens simply because we don't produce any. So when you have such asymmetries between economies like the Northern European ones, Germany, Holland, even Poland these days, whereby you have strong capital-intensive industries with a great deal of, if you want, market power, which is also linked to a degree of excess capacity. And then you have, in countries like Greece, a preponderance of non-tradable goods being produced, services, very low price-cost margins, very low market power of companies. And you have a period of, shall I say, great moderation, or was it irrational exuberance? I think it was both, right? The great moderation part was the touching belief that Ben Bernanke so nicely captured with that term of riskless risk and a permanent state of reasonable growth with low inflation. That paradigm, that touching belief gave rise to massive capital flows, an acceleration of the capital flows, which of course were due to the underlying imbalances that I just referred to. Now, when you have a massive capital influx into a country like Greece, I'm not going to mention Ireland because now I'm told that I'm not a professor anymore, I'm a minister, so I have to remain diplomatic.
Me too.
You have a massive capital influx into a country like Greece. It could take one or two forms. It could go straight into the coffers of banks that then lend it out to developers that then build roads and white elephants, Olympic venues, and apartment blocks and office blocks, which then give rise to a phony Ponzi kind of growth based on the rise of asset values in the form of a standard bubble. Or it could take the form that it did take in my country. It went through the public sector. The public sector borrowed the money and then gave it to the developers. Well, it's just a question of the trajectory. The result is exactly the same. Now, the problem with such asymmetric unions, as we know from the gold standard era, is that they don't end well. At some point, there is a crash. The crash usually starts in Wall Street, for reasons that I think we all understand. It doesn't have to start from Wall Street. In the Southeast Asian crisis of the late 1990s, it didn't start from there. It could have started from somewhere else. But independently of where it starts from, you're going to have a situation where, in this context, in this European gold standard that we created, the burden of adjustment after the burst is going to fall upon the weakest of shoulders. And the institutions that created that asymmetrical union then will have to come to terms with it. Then they have to deal with the situation. Now, we all know you don't have to be a left-winger or a right-winger. We all understand how difficult it is for complex institutions, especially ones that involve 19 nations, to do a mea culpa. At the moment of the crisis, to admit to having created an architectural design that could have been much, much better. So usually what institutions do is they try to extend and pretend, just like bankers do at difficult times. So we had a major case of extend and pretend through what it was, in the end, a surreptitious transfer of potential and actual losses from the banking sector, from the asset banks, books of the banks, onto taxpayers. Our taxpayers in Greece, because we have a certain degree of malignancy when it comes to our tax system, happen to be the usual suspects, the ones who can't get away without paying. They were always overtaxed, simply because the tax base was so narrow. And they were asked to carry this sin, if you want, collective sin of our institutional failures in Europe, and in Greece in particular, of pretending that we have an illiquidity problem when in the end we had a series of insolvency difficulties. Now, it was always clear that the weak shoulders of those usual suspects that pay taxes in Greece would not be able to bear the burden of that adjustment, and those burdens would then shift onto other taxpayers in Europe in a way that is a solvent of the bonds of European solidarity, because you have one proud nation turning against the other, pointing moralizing fingers, which are not helping either with the dealing of the crisis or with the process of European integration, which should accelerate during the crisis. So in the United States of America in the 19th century, every major crisis led to, including the Civil War, led to further consolidation. Again, in the early part of the 20th century, the Fed was created as a result of such a crisis. Then in 1929, actually after 1929, 1933, with FDR and the New Deal, you had the creation of new institutions in response to the crisis that brought the whole thing closer together. And then again in the 1960s, the civil rights movement and even the Vietnam War led to further consolidation under the Great Society. So the big question for us here in Europe, since the word institution is prominent in the title, are we learning the lesson? Are we consolidating the Eurozone? Is this crisis a good opportunity that has been used in order to bring us closer together and to redesign the parts of the architecture which were ill-designed in the first place? Now, the official answer is that yes, we have been doing that. We have created new institutions. We have created the European Stability Mechanism that grew out of that special purpose vehicle called the EFSF. We've created a banking union. We now have a central bank that, after 2 years of struggling, of exceptionally valiant efforts by Mario Draghi, now it has a capacity to deal with, to address the deflationary forces raging across the continent by means of some kind of quantitative easing. Now, are we satisfied with these institutions? Personally speaking, I'm not. The European Stability Mechanism was created, and yet there is a clear feel that at least I get that it was designed not to be used. And that it was also designed in a way that is so institutionally rigid that it can't be used even if we want to use it in the way that it should be used. In a sense, this institutional evolution has led to a degree of rigidity that comes along with the creation of that particular organization that in the end undoes, at least in the realm of perception, what needed to have been created. Let me give you a couple of particularly depressing examples of the way in which institutionally we have tried to accommodate the needs of banks and states within the existing framework of perfectly separable debts and perfectly separable banking sectors. Let me take you to May of 2012, and then at the same, and also August of 2012, referring only to my country. There were these 2 months, May and August of 2012, were months during which the Greek state had to redeem bonds that the ECB had purchased under the S&P program under the presidency of Mr. Trichet. The Greek state was not in a position to redeem these bonds. It was cut off the markets. And the program, which had already been instituted from 2010, was dormant. Negotiations were, as is often in our case, as it is the case today, underway. And during those negotiations, disbursements of the existing bailout funds had ceased. So this is what happened. The Greek state issued T-bills over and above certain limitations, which it sold, in inverted commas, to the Greek banks that were highly stressed, as we know, and therefore had to recapitalize later on. Of course, those T-bills were meant in order to be deposited with the National Bank of Greece, the Central Bank of Greece, under ELA, because at that time ECB financing had been suspended as a result of the problems in the negotiations. And of course, the Central Bank of Greece provided liquidity to the banks so that the banks could give the money to the state, so the state could pay the ECB off. Now, imagine that I had narrated this process in 1993 during the Maastricht Treaty discussions, that this is what we would have to do at a time of crisis. ... Tragically, we find ourselves today in a similar situation. As the Minister of Finance, I have, and this is a common secret, so I might as well share it with you, during these negotiations, in order to create the liquidity which is necessary to see these negotiations through, hopefully, to a sustainable solution, I have to make the same request, that we are allowed to issue T-bills over and above a certain limit so as to create the liquidity necessary to see us through to the end of the month or the next month or June, so as to be able to redeem payments to the former Troika, I should say, to the IMF in this case, but it could have been to the ECB. The ECB bond is coming, 2 bonds are maturing, just like they did in the summer of 2012. They are maturing in July and August. Need I say more? So the big question is, under the current institutional framework, and given the institutional changes that we have effected, can we pat ourselves on the back and say that we've learned the lessons of history, of economic history, of the last few years, that we have forged new institutions that have created the solidity which is necessary, firstly, to deal with legacy problems, with legacy debts and losses, and secondly, to avert future problems? I shall submit to you, and sit down, my very simple answer: no, we haven't. I do not believe that we have the moral right to pat ourselves on the back. I think we have much work to do. Thank you.
Thank you very much, Janusz Varafakis. We now have short remarks, I think, from Euclides Sakalatos, also of the Greek government, but only 5 minutes at most, please.
Okay. Thank you very much, Mr. Chairman. Just to show you that the new Greek government doesn't have herd activity, unlike the banks.
Push your button.
So I have to put...
Yes.
Okay. Just to show that the new Greek government is not subject to herd activity like the banks, which I'll come back to, I'll be sitting down. So I want to start with the argument about moral hazard. You shouldn't help countries that have got too much debt because it creates a moral hazard. If you do that, they won't pay it back. The answer came very well from an Anglo-American economist at Yale, John Yiannakopoulos, who said it's all in Shakespeare, and in particular the Merchant of Venice. You should always forgive debt, because if you don't forgive debt, you will eventually have to forgive debt, hopefully before the debtor has died. What happens then to the moral hazard argument? Well, if somebody has borrowed too much, someone else has lent too much. So solving the moral hazard argument is also about getting banks not to lend too much. Now, in the EU, we knew that. After 2000 and after the monetary union, there was a political decision to replace structural funds and an institutional answer to regional problems through private flows. That was well known. What wasn't well known, because new economic thinking was not at the forefront after 2000, was the economics of this. And the economics, we need to go back to Kaldor and Myrdal on what happens in a monetary union where current account divergencies do not just go away, they just rematerialize as regional problems. So the question that came out from the post-2000 period about regional problems in the EU are private financial flows a good way of getting round regional problems? And the answer we now know is that they are not a good answer to those regional problems. And that is why we've had such a problem in the crisis period. So let me give you 2 conclusions before one final personal note. What follows from what I've just said. We need to reconsider the economics and financial architecture of the EU, and we need new economic thinking that goes back to Kaldor and Myrdal and so on to address the problems of regional divergencies and how they can be addressed in monetary union over the next few years. But with respect to banks, we need more conservative thinking, even a leftist economist. We need banks that go back to their traditional activities, which is to intermediate between savers and lenders. If you look at any of the large systemic banks in the EU at this moment, you will be surprised at their budget, their balance sheet, because from the asset side, most non-economists and most non-financial economists would expect that there was a lot of lending to firms and individuals, but you will find that a lot of the balance sheet is made out by new financial instruments. And this change in the direction of banks affected even non-systemic banks, like the Landesbanks in Germany, who wanted to ape the Deutsche Bank and also carried out this activity in new financial instruments, in derivatives, and so on. And now we hear the argument that public banks do not work because they didn't do very well in the crisis, a reversal of the true causation of a rather obvious kind. So what do we need? We either need more systemic banks that are more regulated, or we need a greater divergence of banks, of the kind of banks we have. We need state investment banks, we need special purpose banks, we need ethical banking. All those types of banks in the high era of neoliberal were categorized characterized as part of financial repression. And thus we did not need them. We need to go back to a pluralistic model where we have these kind of banks. My final conclusion. I grew up in Britain in the 1970s, and the major ideology of the West at that time was that we in the West were the pluralists. The bad Soviets were monoculture of the state and state-owned companies, but we were large in the West. We had a mixed economy, we had private sector, public sector, we had national health services, we had autonomy in the universities. That pluralism has all but gone in the era of neoliberalism, because in the era of neoliberalism, the monoculture is of entrepreneurship and the private sector, and no other solution is considered. What new economic thinking needs is to take back the mantle of pluralism, that there are a lot of institutional solutions at both the supranational and the national level if you want to meet the needs of the many. And all I can assure you, to end on a political point, is that the government of Syriza is committed to learning from people with new economic thinking about what that new pluralism entails. Thank you.
Thank you very much. And now next is Governor Mar Gudmundsson, Central Bank of Iceland. Mar, 10 minutes.
Thank you very much, Chairman. And I would like to thank the organizers, the Institute of New Economic Thinking, for inviting me to speak in this very interesting panel. Now you notice that I am not standing up, even if I am an old trumpet player and on a good day would serve me very well, but my voice is failing me a bit after a cold, so I better sit down. Now, the chairman referred to the Icelandic story in his initial remarks, and I am going to disappoint you. I am not going to tell you that story here, because it is a very complex story, actually two stories. I refer you to books, my own speeches and publications on that. But it's important to though realize, just as a footnote at the start, that in some sense the big Icelandic saga is two stories wrapped in one, and not only that, they are linked, but they are partly separate. And one is this build-up and collapse of three cross-border banks that were 10 times GDP. And they were not really cross-border. They were actually, for a very significant degree, off-border, because they were doing the financing abroad and investing abroad, but that was booked through Iceland, but had nothing to do with Iceland. But as we all know, and as our good friend Mervyn King has said, banks are international in life and national in death. And this is what we are currently dealing with in Iceland, because when they collapsed, they are in the resolution process there. And the second story is a kind of a traditional macroeconomic boom-bust story, having to do with capital flows and certain stops and all the rest of it, something that we have seen played out many times before in Iceland and other countries. So I'm not going to talk about that. I'm going to address rather the topic of the panel and how the Iceland story fits into that. That is to say, Eurozone institutions, national sovereignty, and bank bailouts. And For at least two reasons, I would provide a little bit of a different perspective on this topic than we have been given so far. And the two reasons is firstly what the chairman referred to earlier, that Iceland is not a member of the EU or not a member of the Eurozone, but a member of the European Economic Area. And that means that Iceland has an access to the single market, and banks that are headquartered in Iceland have a freedom to operate throughout the region. But they are excluded, or mostly excluded, from the EU safety nets and safety nets in the Eurozone for banks. Now, these safety nets were not up to much prior to the crisis, but still. And that kind of combination turned out to be a lethal combination. Basically, we had fractional banking with a maturity mismatch, with no lender of last resort, no deposit insurance, no regional supervision, etc., to back it up. But the silver lining was, of course, that Iceland might have had and had a greater freedom to tailor-make the resolution of the banks in its own national best interest, as I will explain in a minute. But the second issue is the currency issue. So Irish banks, if you take an example, they borrowed significantly abroad in their domestic currency. And they had the issuing central bank as a liquidity provider. Icelandic banks borrowed abroad in foreign currencies and had as their lender of last resort the Central Bank of Iceland, which was only able to provide lender of last resort assistance to any significant degree in Icelandic kroner. So just before their failure, and just to give you an order of magnitude, the Icelandic banks had foreign currency balance sheets that amounted to 7.5 times Iceland's GDP. Now, as this is the bread and butter of banking, these balance sheets were embedded with significant maturity mismatches. In comparison, the Central Bank of Iceland foreign reserves, foreign swaps with Nordic central banks and committed credit lines, combined amounted to 35% of GDP. This was, of course, no match for the bank's FX balance sheets and was therefore an accident waiting to happen. And happen it did with a vengeance after the collapse of Lehman Brothers. So how did the Icelandic authorities deal with their failing banks? There certainly were no bailout negotiations with Eurozone institutions. Actually, during the months leading up to the crisis, the Icelandic authorities had widely sought cooperative FX liquidity support, but with very limited results. So given the lack of international cooperation, the Icelandic authorities were forced to consider radical solutions in order to preserve the domestic payment system and basic banking services. And in doing so, they had to take into account that these were private banks, and socializing their losses carried the risk of bankrupting the government. And remember in that regard that it was not enough just to guarantee the capital. You had a foreign currency denominated liability side that you had to shore up, and it was bleeding at that point. So the adopted solution was embedded in the so-called Emergency Act, which passed by Parliament on 6 October 2008. It saved the domestic operations of the banking system by creating new banks, which it did by carving domestic assets and liabilities out of the old failing banks. The rest, and much larger part, went into a resolution process where it more or less remains pending a solution that will enable Iceland to lift its comprehensive controls on capital outflows, but that is another story. Now, in order to reverse the ongoing run on domestic deposits, a declaration was made that all deposits in Iceland were safe, and all deposits in Iceland headquartered banks were given priority over other unsecured claims. And this is a very important distinction. So the latter included the foreign currency deposits in branches, but the first one did not. Now, why did the authorities make this distinction? Because this surely added fuel to the fire of the so-called Icesave dispute about the settlement of deposit guarantees in the Dutch and British branches of one of the banks, Landsbanki. But the issue was that guaranteeing those deposits would never have been credible and might have bankrupted the government had it been attempted. The deposits in questions were in foreign currencies and amounted to 11.5 billion euros, far in excess of Iceland's available FX liquidity at the time, as the sovereign was completely closed off from foreign capital markets. And just to give you a comparison, Iceland's GDP at the time was just over 12 billion euros. So this was almost one GDP. Now, in addition, in economic terms, given that these deposits were used to a significant degree to finance illiquid assets outside Iceland, such a payment, if it had been possible, would have amounted to a net transfer of resources from Iceland to other countries, where the United Kingdom would have been prominent, at a time when Iceland was going through its deepest financial and economic crisis in the post-war period. That, of course, made absolutely no sense. You can see from this that the key characteristics of crisis management and bank resolution in Iceland were that shareholders lost all their equity, unsecured bondholders were bailed in, vital infrastructure elements of the domestic banking system were preserved, and deposits were given preference over other unsecured claims. Today, this seems in many ways a standard approach, but it was not always well received at the time. Now, the only conflict to speak of between Iceland on the one hand and EU institutions and member states on the other centered on the settlement of deposit insurance in the FX deposits in the Dutch and British branches of Landsbanki. The issue was a difficult one for Iceland and one that significantly slowed down the implementation of its IMF program and threatened to derail its stabilization and recovery. And just to put this in perspective, at the time, there were several settlements made. The Icelandic authorities actually made 4 settlements pending domestic rectification, and there were different interest rates. But if we take the interest rates burden only in these settlements, there was something like 15% of GDP, and as the recovery rate was baseline considered, because people were pessimistic at the time to be 75%, that this was something like an overall burden of 1/4 of GDP. Then, in addition, the Icelandic authorities considered the legality of the claim against the sovereign to be highly uncertain. Now, the bottom line was that in early 2013, the claim against the Icelandic sovereign was rejected by the EFTA court. Now, however, the economic risks involved grew smaller over time as the Icelandic economy indeed made a strong recovery from 2011 onwards, and it emerged that recoveries on the failed banks' estates would cover deposit claims in full. And deposit claimants in Landsbanki have already been paid 85%, and the rest is expected pretty soon as further recoveries are realized. Now, the deposit preference introduced before the banks failed is key to these results. The entire episode demonstrates that the framework for cross-border banking in the EU was deeply flawed, and although some progress has been made recently through the implementation of banking union, deposit insurance, for instance, is still not included. Now, I am running out of time, and let me make 3 very short concluding comments that maybe hark back to some of the things that have been said earlier. So the first comment is this. The reason Iceland did not bail out the bondholders in the Icelandic banks, whereas Ireland and some other EU countries did, is probably not because it had better policymakers, and I doubt that they had. The reasons were rather that the nature and size of the problem in Iceland was in some respect different, as I have explained, and maybe more importantly, Iceland did not have the offer of adequate liquidity support in return for bailing out the bondholders. Now, perhaps luckily so. Second, cross-border banking in small countries has to be backed by multilateral frameworks and safety nets. Otherwise, it is too risky. In the absence of such frameworks, my country, to take an example, will be forced to put prudential limits on FX balance sheets of domestically headquartered banks, which will, in practice, limit their international activities. And third and final, supranational solutions can often improve, and often, not only can, but often improve on national solutions. But then their rights and obligations have to be clear ex ante, with political backing and public understanding. Furthermore, the implicit burden sharing has to be fair, otherwise it is unlikely to work in practice. Thank you.
Thank you very much, Mar, for this statement. And we turn now to the final member of the panel, Thomas Fassi, extensively about the European crisis in his own country and which is Italy, but also elsewhere. Thomas, please.
Yes, thank you. Hello, everyone. I would also like to thank INET for the invitation to this panel. I won't be speaking specifically about banks because it is not so relevant in Italy's case. Italy was one of the few countries that did not have to bail out its banking system after the crisis. It did so, but it spent very few billion euros compared to other countries. So I will talk more in general about the interaction between national institutions in my country and Eurozone institutions since the start of the crisis, and what this can tell us about sovereignty, national sovereignty in the Eurozone. Now, I think everyone in this room understands very well that countries belonging to the EMU, and especially the weaker countries, are rather limited in the scope of their national sovereignty. We take this for granted today, but it wasn't always so obvious. In this sense, I think if there's one thing we can thank the crisis for, it is for making painfully clear just what the limits of sovereign decision-making, especially in the economic sphere, are within the boundaries of the Eurozone. So over the 2009-2013 period, as you all know, the Eurozone institutions, in the form of the Troika, to a certain extent, not entirely, as it was said, took control of the economic policies and especially the fiscal policies of a number of member states. I think in these cases, the interaction, in the countries that were subject to a Troika bailout, the interaction between national and Eurozone institutions or international institutions was quite clear, quite explicit, not entirely, but there is an exception to the norm, though, and that is Italy, my country, a country that since 2011 has effectively been implementing with surprising continuity Troika-like policies without the Troika ever being officially involved in the country. So how was this achieved? Well, you will recall that in November 2011, Berlusconi resigned, much to the delight of a great number of Italians, and not only, I think, and Mario Monti, former EU commissioner and former Goldman Sachs advisor, was appointed by a former president, Giorgio Napolitano, to form a so-called governo tecnico, technical or technocratic government. Now, officially, it was purely a matter of internal politics, so the loss on Berlusconi's behalf of the majority within the Chamber of Deputies, and in general, the poor handling of the government, by the government of the crisis, though it was quite clear from the start that there were strong international pressures at play. Many have speculated, for example, that Angela Merkel played a role in the backroom dealings that led to Berlusconi's resignation. Now, I don't know if that is true, and frankly, I don't think it is that important. I think what is interesting about the Italian case isn't so much the politics behind it, so the role of this or that government, but what it can tell us about the concrete factors, besides from the obvious ones, so the Maastricht Treaty, the lack of a central bank, and so on, the factors that limit national sovereignty within the Eurozone, what we could call the unofficial constraints to national sovereignty within the Eurozone, and how these can be used by the Eurozone institutions to influence the national decision-making process. Now, the first factor, and this is quite well understood, is, of course, government bond yields, the infamous spread, which you all know about, and Italy is a perfect example. So on August 5th, 2011, Italy came under the spotlight because its 10-year bond yields had risen above Spain's levels for the first time in a year. That same day, the ECB sent a letter to the Italian government, which was supposed to remain secret but was subsequently leaked, in which it claimed that Italy's post-crisis deficit cutting plan was not sufficient, and it set out detailed demands to the government which included the full liberalization of public services, large-scale privatizations, the reduction in the cost of public employees, if necessary by reducing wages, reform of the collective bargaining system, stricter criteria for pensions, and most importantly, constitutional reform to tighten fiscal rules. Giulio Tremonti, who was Italy's then Minister of Finance, said that month he received 2 threatening letters, one from a terrorist group and one from the ECB, and he said the one from the ECB was worse. He choked. In any case, the government caved in, and a few days later sent a fax to the ECB pledging deeper reforms, fiscal reforms, and the ECB responded positively by intervening in in the sovereign Italian bond market to keep borrowing costs down, and it worked. But within a couple of months, frustration was mounting within the European and international community against what was perceived as an insufficiently aggressive austerity program on behalf of the Italian government. In a recent interview to the Italian daily La Stampa, the former Spanish Prime Minister José Luis Zapatero recounted the events of the G20 meeting at the beginning of November 2011, on the 3rd and 4th of November specifically. And he said, and I think his words are worth quoting in full, "I will never forget what I saw at the G20 meeting in Cannes. I went there fearing that Spain was in the sight of the proponents of austerity, but I was wrong. The target was Italy. Berlusconi and Tremonti were under immense pressure to accept an IMF bailout, but they staunchly refused. Shortly afterwards, I heard Monti's name being mentioned in the corridors, and I found it very strange. Was it a coup d'etat? I don't know. All I can say is that the US and the proponents of austerity wanted to decide Italy's economic policies in place of the government. It is definitely a case that needs to be studied." Now, make what you want of Zapatero's words, but what we do know is that in the days following the G20 meeting, there was indeed a steep rise in Italian bond yields. This is considered by some to be the result of the fact that the ECB stopped its purchases of Italian bonds. We can't know for sure, because back then the ECB wasn't in the habit of disclosing which bonds it was buying, though there is some evidence to support this. But that said, if the ECB's aim was to put pressure on the Italian government, there was no need for the central bank to actually stop the purchases. As you know, the ECB, since the start of the crisis, has ruled by expectations somewhat. So what it says is almost as important, if not more important, than what it does. And by that point, the ECB was clearly signaling to markets its intention to stop its purchases of Italian bonds. So in an interview that was given to La Stampa again on November 5th, the ECB Governing Council member Yves Mersch, on the question of Italian bonds, said, "If the ECB board reaches the conclusion that the conditions that led it to take a decision no longer exist, it is free to change that decision at any moment." Now, I think that was a pretty clear statement. In any case, the fact of the matter is that on Wednesday, November 9th, so exactly a week after the G20 meeting, the interest rate on Italian government bonds reached 7%. Now, this is important because 7 is a bit of a magic number in the context of the euro crisis, in the sense that 7% is the rate more or less at which Greece, Ireland, and Portugal had previously been forced to seek bailouts from the Troika. It's almost as if there's an unwritten rule in the treaties that states that once your government bond yields reach 7%, the institutions, as they're now called, kick in. And I think you can check this out online for yourself. It's pretty clear, I think, that there is a trend there. In any case, now bond yields are not I think in light of this, we can say it would not be far-fetched to say that what happened in Italy in 2011 was somewhat a covert Troika intervention, maybe out of concern that a direct Troika intervention in a country as large and economically relevant as Italy would have been too politically risky. But I think this is what happened, and I think this is somewhat supported by the fact that Monti proceeded to enforce one by one all the policy prescription contained in the leaked ECB letter of August 5th, once he came to power. Now, bond yields, though, are not the only unofficial constraint to national sovereignty in the Eurozone, I would say. I think there's another factor, which is also very important, though it is less talked about, and that is a country's Target 2 balance. Now, as many of you know, Target 2 is the ECB system for coordinating cross-border transfers between central banks. Now, as you can see in this image, between basically August and September 2011, so more or less at the time of the ECB's secret letter to the government, Italy's Target 2 balance, which is a green line, started to plummet. The same happened in a number of countries, especially Spain. So what was driving this? Now, the capital movements between countries in in the run-up to the crisis have been mentioned. So, private banks in the countries of the core, primarily France and Germany, lent large amounts of money to banks in the periphery. Now, by 2011, it was clear that many of these banks were effectively insolvent and were likely to default on their repayment obligations. So what happened was that through the Target 2 system, the central banks of the core countries, first and foremost Germany, lent funds to the central banks of the core of the periphery, so the central banks of the periphery could fund their private banks and allow these banks to repay their private debt to the banks of the core. Now, this did, in effect, prevent a number of periphery banks from going under, but it also divided the continent into creditor and debtor nations, although as periphery core private debt was transformed into central bank debt. And you can clearly see that in the following image, which tracks the rise of the Target 2 balances between 2007 and 2014. So you can see below the line, that's the red area is the total Target 2 debtors, a large part of which is accounted for by Spain. And above the line, you have the green area, which is the total Target 2 creditors, a large part of which is accounted for by Germany. Now, Target 2 is essentially foreign debt. Target 2 debt is essentially foreign debt. And as such, it does place, of course, clear limits on a country's autonomy. And I think this is quite clear in Italy's case. I mean, once Italy's central bank started to accumulate large amounts of Target 2 debt vis-a-vis the central banks of the core, and especially Germany, it found itself somewhat shackled in the same manner of countries that were subject to an overt Troika-backed sovereign bailout. I think partly explaining the events that followed in Italy. Now, it would, of course, be an exaggeration to say that Monti was imposed upon Italy. I mean, after all, the whole operation was piloted and overseen by our former president, Giorgio Napolitano. But I think this underscores another point, which is that Monti's technocratic legislature wasn't just a one-off exception to the norm, followed by a return to normality, insofar as Italian politics can be considered normal, but was rather the beginning of a new normal, the first stage of a regime change characterized, I think, by the prominence in Italy of a new political class personified by our current prime minister, which has understood the lesson of 2011 very well and understands very well that its political survival is dependent upon its willingness not to challenge the fundamental ideological technical underpinnings of the monetary union. And for this, it receives, it is allowed the bare minimum concessions necessary to maintain consensus and guarantee political stability at home, such as, for example, a slightly more flexible implementation of the union's budget rules. Now, I would just like to conclude by saying that in this sense, I don't think the Italian case is an exception to the rule. I think it is rather paradigmatic of the direction in which the Eurozone is heading in, and that is a system in which macroeconomic policies are fundamentally decoupled from the democratic decision-making process by way of complex rules, self-correcting mechanisms, and so on, and effectively insulated from the democratic process at the national level, most obviously, but even at the European level. And I think this is a very worrisome development, which we should all give more thought to, I think. Thank you very much.
Thank you very much. This was the end of the intervention by the panelists, and we are now opening for the floor for discussion for about 20 minutes at least. Let me say that I cannot resist making a comment on the latest intervention by Thomas Fassi, because what he said about the events in Italy in 2011, I think also has wider implications. In fact, the lesson drawn from that experience of imposing certain measures on Mr. Berlusconi, which he may not have followed to the extent intended, was that in the following year, the ECB recognized it could not go that far. So when they announced the market transactions, the OMT program, it was clearly linked to a political decision in Europe. It was not the responsibility of the central bank to decide whether the European Central Bank could buy unlimited quantities of bonds. It could only be done if that country had entered into a program. Well, that's one, I think, lesson from the Italian, that thing was corrected in a way. But of course, in Greece, there was a similar situation at the time when Mr. Monti came in. You had a technocratic government under another economist colleague, Mr. Papademos, Lucas Papademos, former Vice President of the ECB, and that lasted only a few months, of course. These were worrying signs, I think, of interventions in the political system. If I may make one remark also to Minister Varafakis, I think much of your characterization of the monetary union and its asymmetric nature is fair enough. It is clearly designed more to, and with the reforms that have been done, to prevent future crises and to solve the legacy issues that we are faced with in the case of Greece. They have proven particularly difficult in the Greek case because the measures that have been taken have, in contrast to other economies, and I think of Ireland in particular, but also Portugal and Spain, which have gone through a somewhat similar program, has led to a revival of the external sector in these economies that has compensated somewhat for the austerity. The single central feature of the Greek economy seems to be that this doesn't happen in Greece, and that is a serious issue of a more structural nature that cannot be dealt with by liquidity policy. It's true that the monetary union is asymmetric in the sense that it only centralized monetary policy, but it left all the rest of economic policies to national states, and the philosophy was at the time that this should be enough to make countries live with a fixed exchange rate or with a single currency when they had all the other instruments of adjusting and where they were very keen. And the Greek government was one of the keenest countries to join monetary union in the 90s, late 90s, when Greece, in fact, decided to move ahead. So this was just a comment. Many of your analysis, of course, are fair and correct. The glass is clearly half empty, but who's going to fill it up? And you have to answer also not only to the creditors, but also to the countries that have gone through a successful adjustment program, more or less to the Portuguese, to the Irish and others. So let me open the floor for questions and discussion. Of course, we come back to the panelists. They will all have a chance to answer in the end. But could I have questions and comments? And please give your names. I don't know you all here. So, yes, please, go ahead.
Thank you, Heather Graby from Open Society. You have all, in different ways, explored the question of the relationship between state sovereignty and economic policy in an era not only of globalization, but of massive interdependence, particularly in the Eurozone. I think the big political question is, of course, what this means for democracy. But there's also a very big question for economists. Does, in fact, the international coup, as Thomas Fazzi put it, or the imposition of demands from international level, whether that be EU or IMF or indeed from elsewhere, does it actually lead to better economic governance? Does it lead to better economic policy? That seems to be the unfinished question of the Eurozone crisis. I think that Mario Monti would probably argue that the coup was justified because it got Italy out of a much worse economic situation and it led to improvement, and therefore technocracy had to come in at that point. I'm not sure if Janusz Varafakis would agree with that, whether that would have been a better outcome for Greece. But ultimately, given that voters won't consent to larger scale financial infrastructure, that's why the Eurozone was never given a complete infrastructure at the very beginning, because the German voters wouldn't wear it. We're going to have this more and more in the future. But does it lead to better outcomes in terms of economic policy in the end? Is it worth giving up democracy for those outcomes?
Thank you very much. Question from...
Okay. Steve Keen from Kingston University, London. I'm looking at an OEC document right now called Going for Growth 2015, and it raises the issues by your question and also Thomas's presentation, of course, Janus's, because it states the countries from 2007, before the crisis, to 2014 on the degree of responsiveness or economic reform. The document itself is called Going for Growth. One would think reform would lead to more growth. The top country for reform is Greece. Second, Portugal. Third, Ireland. New Zealand squits in there. Then Spain. There seems to be a negative correlation between what economists call reform and what happens to growth. Please comment.
Thank you very much. Who's next? I'm sorry, but I have one more speaker first. The lady there.
Hi, I'm Yuan Yang from the Student Campaigning Network Rethinking Economics. Economists often talk about institutions as if they can design them from scratch on the abstract, on a sheet of paper from nowhere, and they can just design a perfect institution and then see how it will work. But in the case of the Eurozone, in the cases of quite severe breaches of sovereignty, as Thomas Fuzzy described, and we're not starting from scratch, there are already players who have their vested interests and who have some small room for manoeuvre perhaps to change those interests. So given that any Eurozone reform of the institutions that will lead to, say, less dramatic imbalances within the Eurozone will benefit some countries and will be seen as huge impediments by other creditor countries. What do you think is the sequencing of different reforms or the sequencing of different moves that can be made to mean that the political economy of the Eurozone leads to the actual economics that you want to achieve?
Thank you very much. Next, Mr. Peter Jungmann, I think. And then you.
Yes, thank you. Some people may be surprised, Minister Varafakis, that in 2 points I would agree with you. And the first is that when you said that on the rules and the architecture of the Eurozone, maybe if I got you right, Greece should not have become a member, as it was not able, as you said, to survive or to compete with countries who have strong capital intensive industries, being a country which basically was living on a lot of non-tradable goods. And the second remark, I would agree that the 2010 bailout was a mistake in the sense that the richer countries rescued poorer countries for them to be able to rescue the banks of the richer countries. That is what happened, in particular with a lot of state-influenced banks in France and the state-owned Landesbanken in Germany. Where we may not agree is that Greece problems, and maybe you can comment on this, are not derived from the last couple of years. They piled up debts in boom times while they were growing from 1998 to 2008 or 2008, with an average growth rate of 3.8% per annum, and doubling sort of the GDP, debt-GDP ratio at the same time. And in a document, and maybe you want to comment on this, from George Bidros, who came out the last days and is published now at the Springer Publishing House, he basically goes back to 81, when a lot of what is now under discussion as reforms has been promised to introduce, but it was disrespected, and the entry then into the EU was basically a political issue and not an economic issue. I would like to see your comments on that, in particular when it also referring to the fact that between 1898 and 1942, there was already an international Greek committee which basically regulated the capital flow in and outside the country. Thank you.
Thank you, Peter. Yes, you.
It's me. As a journalist, I've always thought that I shouldn't make statements or speeches, but listen to conferences. But this time, as an Italian journalist, I have to say something. I'd like to ask Thomas Fuzzy what is his idea of international cooperation, whether a debtor of 2 trillion euro should not be discussed in the G20 or in the EU or in the euro area. I think it makes complete sense to discuss such a systemic event as interest rates at 7% that were already, as was already the case for Italy at the time. You talk about covert troika intervention, if I remember correctly, but then I don't see how this reconciles with what actually happened. Of course, Monti came in and he implemented a few measures, but he didn't call in the troika, first of all. And if you look at the letter of the ECB, whatever you might agree or disagree, I don't get into that point, but if you look at the points that the ECB letter raised, Monti actually implemented probably 5% of them. And some people might even claim that he didn't do enough. He just passed pension reform. Then there were probably another 10 points that were completely disregarded. So I don't see the consistency of your argument in there. And then you talked about an international coup, but then I would like to remind you that if you look at election results, it's true that parties that opposed current policies reached probably about 30% of the vote, but then the 70% of the voters and the parliaments, last parliament and the current parliament, are actually supporting. This is a parliamentary democracy. So I really don't understand what is your idea of international cooperation and why you don't think the G20 or the Euro area should discuss extreme situations like that. Final point, here we are talking about 4 Troika programs, right? Spain, Ireland, Greece, Portugal. 3 of those countries, whatever one might think of the merits of those programs, are among the fastest growing in some cases of the world. Am I referring to Ireland? Is, I think, in the top 20 fastest growing countries currently. One country is not, and this is Greece. Another country, like Italy, is also among the slowest growing, and one might claim it didn't do many of the things that a covert Troika interventions could have entailed. So I don't get into the merits, but probably this might be part of the discussion.
Thank you. Yes, the gentleman behind there. If there are others in the second rank. No, that's not. Go ahead. You need a microphone, I'm afraid. You have to go to the table.
It seems to me that the underlying political economy of the Eurozone crisis is that every government is captured by its banking system, but some governments are more powerful than others. Now, if you accept that characterization, is it really credible that we are going to have a bank resolution mechanism that involves creditor bail-in? And if it isn't, how are we going to deal with this problem?
Yes, thank you very much. I wanted to, I'm Pier Paolo Barbieri, so as it's clear from my name, Italy is also my country. And so in the context of some of the comments that were made, I wanted to build on 2 of Federico's points. The first one is about the legitimacy, and the second one is about how these bailouts are decided. I think it's very dangerous indeed to talk about overt coups when all we're doing is actually quoting one actually quite disgraced Spanish prime minister and what he might think of a program in a country where, you know, he was overseeing a bubble, and then the successor governments were forced into very difficult situations to deal with the policy accidents that were created by that administration. I don't think that Mr. Monti was somebody that was unknown to anybody before, especially given his work on European integration. So you could argue many things, but not that he was an unknown name. So it's very difficult to use the word coup in that context when we really don't have any real evidence, or none is actually presented. And to build on that, it's the point about legitimacy that Federico touched upon. It's important to remember that last year's European elections gave the largest single percentage of any winner party in Europe to a party in Italy led by Matteo Renzi, now Prime Minister, who is actually calling for structural reforms. From the left, perhaps from a social democratic left, but is actually calling for the very structural reforms that have been successful in Spain, and as we saw from the presentation, have been successful, or at least better than the alternative, in Ireland as well. So countries have a choice. They can close their fiscal deficits overnight, as some countries have done in history. You can see the example of the Argentine default in 2001 and what that does to the social cohesion of a country. But there is a choice to the bailout. And there are certain countries, at least, that are voting for these reforms. And in the case of Renzi, it is very difficult to see how, if you start from a coup, then you have a country that votes for the very change that, in this idea of the world, would not only be unpopular, but also would be imposed from abroad. Thank you.
Gentleman from the other side.
Thank you. My name is Marco Valerio Loprete. I'm from Il Foglio, an Italian national newspaper. My question is for Mr. Varufakis and Mr. O'Nohan. How does it feel to have Mr. O'Nohan closing his remarks saying the Troika program in Ireland was a very good net success for the country? Was it that was the same asymmetric Eurozone you were talking about, Mr. Varoufakis. There was the same troika. So what happened? What was the difference? Thank you.
I'm afraid I have to end with another two questions. So two ladies, one there and one there. Yes.
Thank you. Thank you. I'm Domna Mikhailidou from University of Cambridge and the OECD. If I understand rightly, we're talking about a new financial architecture, or the need for a new old financial architecture, as Mr. Varoufakis said. So my question is the following. How do you practically, and most importantly, as you are a man of politics now, Mr. Varoufakis, as you said, pragmatically envisage such a need when from the micro scale of Greece, we see that a new financial architecture is so hard to design that our main success so far, and I stress the so far, has been in obtaining new deadline extensions. Thank you.
Thank you. Ingrid Melander, I'm a journalist for Reuters here in Paris. A question for Minister Varoufakis. Hello, Minister. You mentioned the difficulty of having to maybe ask for more be allowed to issue more T-bills while the negotiations are going on. I wanted to ask you, as we stand now, I mean, how much time do you have before Greece is running out of cash if there is no solution? And the second question, if I may, we understand there might be sort of new demands by EU partners that you send some more detailed reforms, maybe by April 21 or 22nd, I mean, before Riga. I just wanted to ask you whether you could comment on that.
This last question may be a bit difficult to answer. It's a bit outside the agenda, I think. But let us see, are there one or two more questions? Last chance? Yes.
Anush Kapadia from City University in London. Mr. Sakalotos, you made a plea for institutional pluralism, which I very much agree with, and I'd like to push you on that. If we have to evolve, if it's true that private institutions funding the gap between North and South Europe have failed miserably, which they have, and have adverse effects, and we have to then invent new ones to fund this gap, what might the shape of those institutions be? And I submit to you they might have to have three features. One, they would have to be banking institutions because they are liquidity and maturity transformation demands that the structure of Europe and the varieties of capitalism within Europe demand. Two, they would have to be public as opposed to private because there are huge moral hazard and informational problems in private markets that have led to mispricing of sovereign debt. And three, perhaps they would have to have punitive aspects to them, not unlike Keynes's Bank Corps plan. That would have to penalize both creditors and debtors who would borrow or lend beyond certain thresholds. But what about your response?
Thank you. I'm Joe Stiglitz, Columbia. Two questions. One has to do particularly with Ireland and the decision not to restructure the debts, and not, in particular not to bail in, you might say, the unsecured creditors. My understanding from a very reliable source in the IMF is that they opposed that. They thought there ought to be restructured. And this was a decision, therefore, imposed by the European authorities. It's been raised several times about the political economy. This would seem to be a good example of the banking institutions working through the ECB and the European Commission to try to preserve the assets of the banks at the expense of the well-being of the country. I wondered whether you and the other people would like to comment on that. The second question is a little bit about a lot of the questions around have been talking about whether the policies since the crisis have been a success or failure. You know, most persuasive, the countries that have done the reforms have actually not done very well. Another way of looking at it is if you look at the per capita income or output per working age population, in most of the countries that are under so-called programs, they've been a disaster. They're not back to where they were. You can say, well, yes, they're beginning to grow, but it's still the case that there's been already an almost more than a half decade of lost growth, and the prospects, the potential growth, everybody recognizes has been significantly lower than it would have been had there not been a crisis. So you look at it from a general theoretical point of view, you ask the question, after the human capital, the physical capital, the natural capital in Europe was the same in 2009 as it was in 2007. Is basically the same in 2015. But somehow, even though the resources are the same, output has been markedly lower and standards of living have stagnated. And I don't see how anybody can call that a successful program. That was not just a rhetorical question.
For time now. One final question. Okay.
Thank you. I'm Panagiotis Barkas from the OECD and the University of Cambridge. I just wanted to ask one very brief question, actually, about the institutional side of the crisis in Europe. Many times have been mentioned that the current institutions in Europe are either about to embark on a new role or change their perspective, or institutions like the ones that have been recently created, ESM, etc., are either doing a job different from what they were created about. Do you see there's going to be a change in the way that these institutions will deal in the short run with the crisis, or is it like a very long-term perspective that we have to expect to change the institutional framework, but in a very decade-long, maybe, perspective? Thank you.
Thank you very much. I think we will close the list at this point and turn to the four panelists. If I may myself try to answer one of the questions raised from the other side of the table. I recall sitting in this room as chairman of the committee in the OECD that examined country economic performances before the crisis, that we did praise indeed the three countries you mentioned. Ireland was the fastest growing economy. Greece was the second fastest growing economy, and Spain was the third fastest economy. Is there really, as you suggest, a negative correlation between growth and reforms, or what is the problem? I think we should not mistake the very good, in a sense, growth performance just before the crisis by several of these countries with reforms. It's a sad story that only Spain, after having reached more than 20% unemployment for the third time in 30 years, began reforms in a serious way with the labor market reforms of 2012. They didn't happen, but you can do a spurt by stimulating demand, and particularly domestic demand, either public consumption as in Greece or construction as in Ireland or Spain. But that's not a sign of reforms. That's a sign of over-optimism, which cannot last. It's not sustainable. It would have broken down under any exchange rate regime in the euro area or not. So I think you put the wrong question. If you can have a response if you want.
Well, that data covers 2000, that's a document from 2015, including performance across that entire period. If you have a process of so-called reform covering that period, and you have the crisis, which Joe's talked about as well, I think you have to challenge the definition of reform. Are we reforming toward a textbook model which does not apply in the real world, and when you apply it in the real world, it causes economic catastrophes?
We'll leave the rest of the responses to the panelists. I think I'll start with Minister Varafakis, please. Most of the questions were for you, but you can defer. Patrick can start again if he wants.
All right, of course.
Fine. Okay. Okay.
Let me say three things. First of all, interesting question of Ireland, some Ireland versus Greece question, but I won't talk about Greece. I don't see that at all. No, I don't see it at all. But I would say about Ireland was in a much more favourable position than Greece for getting out of the hole that it got itself into, because it is very much a globalised economy. It had an inherent dynamic potential. The path was available to it. So I think that made a difference. And that speaks a little bit to this question of reforms as well. I haven't looked at the OECD paper, but I could imagine that steps taken to reform, the Irish economy was already probably towards the frontier of what the OECD regards as reformed economy in 2007. Those dials were already up towards the max, and so it was a question of you're looking at rate of change rather than level of reform, I would suspect. Now, as to whether it's all this business is a success, I did say that entry into the program, or the program as such, was a success. I'm not saying that Europe couldn't have handled this a lot better. I'm saying that relative to saying, no, we won't go into a program, we'll struggle on, we will refuse that, we will try to navigate our own route, it would clearly not have been a good idea. But it could have been better. And that speaks to the question of this bank bail-in question, which Joe Stiglitz has raised. There are three. Well, actually, let's simplify. There are two essential time points. There's September 2008, immediately after Lehman's, when the Irish government guaranteed everything, including lots of subordinated debt, which is a very funny thing to do. And old debt. Why you guarantee old debt? They're not going to pull the money out. So there were a lot of. That was technically a flawed decision, and money could have been saved there. How much did it cost in the end? Net on net, about 40 billion, which is a quarter more than a quarter of GNP, a quarter to a third of GNP, net on net. That's a lot of money. Could you have got away with saving all of it? Probably not, but you would have had to put in probably some kind of deposit guarantee and so forth. But it could have been handled a lot better. Now, the institutions, European institutions, weren't involved in that. That was a solo run. Now, 2 years later, when the guarantee period ran out, initial guarantee period, then there was the question of they're into a program, and the IMF team, yes, they rolled up their sleeves and said, okay, I think we can do this because at last we have an opportunity to have bail-in of banks, which is long overdue, and there's been an concern to protect banks. And IMF staff, I think right up to pretty senior levels, maybe the top level, had decided we're going to go for this. It wasn't going to be easy, and when it came down to it, there were only about 5 billion of unguaranteed debt in the failing banks. The other banks are continuing. So that was where the discussion focused on, the 5 billion, which is rather small. They went in thinking there was more, and then they discovered, these are covered bonds and secured lending. So it wasn't all that big. Now, who backed? The IMF backed away in the end. In the end, IMF top brass did not back that proposal. And we know from different sources, but everybody can see from Tim Geithner's own memoirs, he said, you guys are crazy. For 5 billion, you're going to bring down the whole European banking system, something like this. So it wasn't just a European perspective. There were other players involved. Everybody is unhappy about that in Ireland. We were cooking up, I think I've said it in the text that we were cooking up, how can we do this quietly? IMF came in, let's do it. We'll politicize the whole thing. No, you can't do it. So we couldn't do it then, and we might have been able to slide it in quietly. Subsequently, we did actually liquidate Anglo-Irish Bank, but unfortunately at that stage, with the recapitalisation of that, there was enough to pay everybody. We weren't sure that there would be, but there was in the end. So that was an unsatisfactory episode, but not disastrous for Ireland. Bad for the whole business of bank bail-ins and resolution and the whole, it was an opportunity to do that, but it wasn't going to happen then. Just one more point I want to make. Speaking to this whole question of sovereignty and governance, and I don't want to, I obviously am not in a position to speak too explicitly about this, but I think we've seen an evolution. I think in the early year, the first 3 or 4 years of the crisis, there was, policymakers were frightened. They were frightened about the banking system. They didn't know what were the consequences of doing things to the banking system. They were very frightened, but also there was the ECB was in the position of, actually, it had been set up as an entity which was quite apart from politics. It was supposed to be a technocratic institution just running monetary policy, a little bit like a gold standard, but sort of a human invention of the. But in this face of this crisis, they behave. That's a Victorian idea, sort of a 19th century idea of gold standard. So the reaction of the ECB in those years was a little bit like what people like Rothschilds and J.P. Morgan were doing in the 19th century. They're saying, oh, well, we have a delinquent government here. It really needs a lot of help, but we will help, but they'll have to do this and that. So they got into that kind of Victorian attitude to it because there was nobody else to do it. And I think if you talk to Jean-Claude Trichet, he'll say, we were the only people who could do anything. But that definitely evolved. The ECB is not as so overexcited about banking systems now. It's prepared to go in for resolution. It's prepared to say to banks, come on, you want to have bail-inable liabilities and so forth. But also, there's been an evolution in the thinking of equilibrium in the economy. People are thinking more in terms of multiple equilibria. And that is the key to the July 2012, Mario Draghi, whatever it takes. It's a multiple equilibrium. It's not a Victorian idea of economic equilibrium, but the fact that you can do things that push you into a better equilibrium. But to get that is not just an economic insight. It requires building a political consensus. Now, around this table, it might not be so hard to build a political consensus about that, but believe me, and I'm not exposed to this, but other members of the Governing Council of the ECB are very exposed to concern, anxiety about this kind of increased radicalism of the ECB.
Thank you, Patrick. Janusz Varafakis, please.
I shall concur entirely with Patrick that we have, Keynes taught us about the paradox of thrift. The Eurozone is teaching us about the paradox of central bank independence in the context of the ECB. The attempt to ring-fence Frankfurt, the ECB, from politics, has produced a highly politicized bank. This is what I call the paradox of central bank independence in the European context. I do not blame the Governing Council of the ECB. They have to operate within certain strictures that they shouldn't have to operate within. And in their attempt to do some efficient firefighting, they have to fully politicize what they're doing. So this is something we could have a whole session on. So because I have another gig later on, I'll try to minimize my intervention now. Let me disagree with Patrick on one thing. I understand that as a central banker you have to portray the glass as half full. I don't like the metaphor of the glass. In the case of my country, the glass is broken. And beyond that, let me say that those of us who still think of ourselves as teachers and who will at some point return to teaching, in the next 50, 60, 80 years, the last 5 years are going to be a great case study of how not to manage a crisis in a monetary union. Of course, we have to put a brave face on it, and we have to try to minimize the fallout from this comedy of errors that has been the last 5 years. On the question of Greece, I'm going to have more to say later on when with Joe Stiglitz we're going to have a conversation. But let me just very briefly say that the Greek government, especially this Greek government, is not passing the buck. We're not saying that the problem with the Greek economy has to be pinned on the Eurozone. The Greek malignancies begin in 1827, I believe. And the problem with public debt begins with the first loan that the nascent Greek state secured from the Ricardo brothers. Yep. So there is, of course, a very good reason why Greece was the first domino to fall. And that was because of the malignancies of the Greek social economy. But, trust me, there is no way that you can explain the fact that we had a 40% drop in real wages and export growth has been flat and there's been no recovery without understanding the malignancies of the Eurozone and of the problems of its architectural design. On the question of democracy, your question. I think it's a poignant question, pertinent question. There is the view that the Troika has been visiting one capital after the other, trying to deliver its bitter medicine and to have us swallow it. And because it's bitter, like recalcitrant children, we have been pretending to swallow it when we have been spitting it out, resisting it, and so on and so forth. That's a metaphor. I think it's the wrong metaphor. The medicine is not just bitter, it was toxic. It was not particularly therapeutic. You ask the question, why is Greece still in the throngs of this terrible debt deflationary cycle in which it never exited from, despite rumors to the contrary about 2014 having marked the beginnings of a recovery that never happened. If you look at nominal GDP, it's been falling, except that average prices are falling faster, so real GDP went up. That's a sign of a Great Depression, not of recovery. Okay? The reason is very simple. Because we were the flimsiest of the economies of the Eurozone, and we fell first, the Eurozone experimented on our back, and our governments experimented on our people's backs. We took a hit for the rest of the Eurozone, and for the fact that there were absolutely no mechanism and no actual clear thinking on what to do. So if you look at the fiscal consolidation that we've effected in Greece, and compare this, just to a graph. Paul Krugman did one quite nicely. Just on the x-axis, fiscal consolidation between 2009 and 2010 to today, and on the vertical axis, GDP growth. You'll find that Greece is a complete outlier. Why? Because we had massive austerity compared to what Ireland had to suffer, compared to what Portugal had to suffer. So the reason as to why Greece is doing so badly is because we had much, much more austerity, and in conjunction with a reform program, which in a country that needs really serious reforms, inverted the pyramid. What we effectively did, in conjunction with the Troika, the IMF, and so on, we took the least significant cases of rent-seeking and attacked them, leaving out of the picture, off the radar screen, the most substantial examples of rent-seeking, and those rent-seekers were part of the regime who were empowered to impose the reform program on Greece. This is why the Greek people elected us, not because they suddenly went radical left-wing. And let me finish with one question as to, I believe it was your question, should we have become a member of the Eurozone? I don't believe that anybody should have become a member of this Eurozone, the way it was designed. The point, however, is, and so that I do not get misquoted by certain friendly journalists, it is one thing to say we shouldn't have gotten in. It's quite another to say we should get out. So please make sure that you do not misquote me with headlines. The Greek finance minister is favoring exit. Right? It's Hotel California, last verse. You can check out any time, but you can never leave. Okay? Now, I don't buy the touching stories about optimal currency areas and all that. The United States of America is not an optimal currency area in my estimation. I don't believe that Britain is an optimal currency area. Anybody who's been to Yorkshire knows that. Right? But what is it that binds these monetary unions together? That they have shock absorbers and they have mechanisms, automated mechanisms, for recycling surpluses, deficits, losses, and profits within themselves. In the Eurozone, we don't have them. So I would have loved Greece to have entered the euro if the euro had been properly structured. Now that we are here where we find ourselves, I believe that the greatest critics of the architecture of the Eurozone have the moral duty to fix it, not to discuss fragmentation of it, because fragmentation of it, as Nick Calder said in 1971 in a New Statesman article, would be the end of Europe. Thank you.
Thank you very much. Mark Goodmanson.
Yes, very, very briefly, I'm going to address a little bit the second question from Joe Stiglitz. Now, and one is a general point and the other one is a more specific point regarding Iceland, which then has a general relevance. So the general point is that, yes, the fact that we have still very big output gaps doesn't necessarily reflect on these program countries, because that is an issue for many countries that haven't gone on programs. And we know from, as a fact, that it takes output much longer to recover after financial crisis than it does after of the crisis, and so we have to measure these countries against that yardstick. But I think you're right in general. Now, on the specific point about Iceland, is that Iceland has recovered and is probably at full employment at the moment, or very close to full employment. Now, real wages growing 5.5% last year, and unemployment rate close to 4%, and the unions claiming double-digit wage increases is a sign of full employment, if you like. Now, I think that there are many reasons for that I can't go into, but I think that in terms of the IMF program for Iceland, having looked at what was done in other countries, I think it was a pretty well-designed IMF program in many regards. And I have a suspicion that Joe Stiglitz lent a little bit of a helping hand behind the scenes, because he had written about Iceland, and the IMF people probably talked to him before they went there. And the second reason is that there was always a very strong local ownership of the program. And I think that is key in all these instances. Thank you.
Thank you, Tamar Gudmundsson. And next and last will be Thomas Fazi.
Yes, I will be very brief as well. A lot of issues were raised, and there's not enough time to go into each of them in detail. On the issue, was it a coup, was it not a coup? I think I made it pretty clear that mine was an interpretation of the events based on the facts that we do have. One is free to disagree with that interpretation. I think it's pretty clear that the ECB did use its prerogatives and its powers to unseat the Italian government, but again, this is just an opinion. I think only time will tell. Being Italy, it might take a long time for the truth to come out, but maybe one day we will know. On the issue of the debt, yes, I do think, of course, 2 trillion euros in public debt is a problem. Of course, the international community and the creditors should be involved in tackling the debt. I would like to see the international community propose solutions to make this debt sustainable, not to make it more unsustainable, which is what these policies have resulted in. The public debt in Italy has grown very much since the start of the crisis and since the imposition of austerity policies from about 100 to 130%. Now, I think tackling Italy's public debt means, first of all, tackling the issue of interest payments, for example. Italy pays about 5% of GDP in interest payments every year, amounting to about 80 billion euros a year. This is a massive amount of money that is transferred to the creditors every year, and is also the reason why Italy's public debt has been growing in both nominal and debt to GDP terms for the past 15 years, or 20 years, despite Italy having the highest primary surplus, I think, in the Eurozone since the early 1990s. So I think, Italy is a pretty clear example that you don't tackle public debt through primary surpluses, because if that were the case, if you don't control interest payments, because, you can have as high primary surpluses as you want, but if you pay 5% of GDP every year in interest payments, you're always going to have to get indebted to pay back the interest on the accumulated debt. And so I think to prescribe even higher primary surpluses as a way of tackling the debt is crazy. I mean, to follow the prescriptions of the fiscal compact, which would require Italy and other countries to acquire public primary surpluses in the range of 5%, 6%, 7% of GDP for the following 10, 20 years, I think is folly, but it is what is prescribed by the debt reduction rules of the fiscal compact. So I think tackling Italy's public debt means tackling the question of interest payments, and of course means a wider restructuring of the debt. And this is a problem that I think concerns not just Italy, but a number of countries in the Eurozone whose debt is effectively unsustainable. Now, the ECB's letter, yes, it's true, Monti didn't impose all the policy prescriptions. A number of them, especially the structural reforms, were imposed by the successive governments. And, for example, we see Renzi now pursuing a labour market reform in line with the sort of Troika directives. Whether the program was a success or a failure. Well, in my country, I think it's quite, the program, the policies, whether it was a success or a failure. Look, Italy's GDP is 10% below pre-crisis levels. Its industrial production is 25% below pre-crisis levels. Its per capita GDP is down to the levels of 1997. This effectively making it, with the exception of World War II, the longest crisis in Italy's history, so longer than the Great Depression and World War I. So I think it's pretty clear that that this is not working for Italy, and that without a radical change of economic policy and radical change of the Eurozone architecture, Italy will never get out of this crisis. On the issue of reforms, finally, Italy is considered to have a hyper-rigid labor market by most people. But I mean, even the OECD puts Italy's labor market among the most liberalized and precarious labor markets in Europe. And what we've seen is that as our labor market has got more liberalized, this has had almost no impact on unemployment, and it's actually been paralleled by a worsening, dramatic worsening of productivity levels. So we've seen that, I think, again, another example of policies that do not work. I think Italy is often assumed to be a failed country because it hasn't followed Europe's prescriptions, but I think in many ways it has failed because it has followed them a bit too strictly, I think, in terms of primary surpluses and labour market liberalizations in the past years. Thank you.
Thank you, Thomas. Minister Sakalotis mentioned that he had also a question, I think, that was addressed to him, so he will have the last word.
Two responses, one on debt and one on the question over here about financial transfers. I think it's important to think about debt, that it's not just a matter of economics. I think it was Alan Blinder in the 80s made a quip about monetarists that inflation was a purely monetary phenomenon in the same sense that shooting somebody is a purely ballistic phenomenon. There's clearly politics behind how inflation is created, and there's politics behind how debt is created. And you say here on my left, geographically, not politically, as I understand it, that Greece did not have, didn't solve its debt problem in the good days when it has growth, but nor did the Anglo-Saxon countries solve their private debt. The bottom line is that both neoliberal and more statist countries since the 70s have not had the economy that has provided sustained growth in wages to be able to finance the welfare state, and they've tried to fill the gap with debt, either private or public. So debt has gone up in all countries. Whether it's private or debt seems to me less significant than the fact that debt has grown up. In other words, the neoliberal promise of ex post justification for its policies through performance just hasn't been materialized. And that means that the EU, as well as other regional blocs, have to look at both the production and the financial aspects of a new architecture. And that is the second, in the question that you put, I agreed with the three examples that we need to do. Just to go to Janusz's whether Europe is an optimal currency area, Charles Goodhart's apart from the Kennan criterion that we used to teach and the Mundell criterion, Charles Goodhart said that if there's no social solidarity, then it's not an optimal currency area. And that means that you need fiscal transfers, but then you need fiscal transfers that actually promote new productive and consumption prototypes, because it's the lack of productive and consumption prototypes that created the debt, whether that was private or public, that created crises of different forms in Anglo-Saxon and in other economies. And that's why crises of capitalism like the 29, like the 70s, and like the present, never return to the status quo. They never return, they haven't in the previous two times, so the new economic thinking of this fine institution needs to provide us input of what will be the new model that will follow the third major crisis of capitalism since the beginning of the 20th century. And that has to match production and financial issues. You're not going to solve it just by solving the financial issue. Thank you.
Thank you very much, Mr. Tsakalotos. We've come to the end, and I'm sure you will want me all to join in applause for the panelists. We've had an exceptionally rich 2 hours, and we are now ready to join the minority of the conference that has not been in this room. So, see you again at 2 o'clock.